episode of The Harvest with me, Carmel Fisher. On today's Thought Leader series, we are interviewing Mr. Lane Kawaoka. Lane is a man of many talents, the CEO of the Wealth Elevator, and ex-engineer, current investor, family office consultant, owner of 10,000 plus rental units. And I'm excited, Lane, today to dive into your history, your story, and of course, some interesting nuggets that can help myself and our viewers and audience, just learn the tricks of the trade and also the little secrets that do come from those family offices and their success. Off the bat, welcome, and please jump straight into a bit of your history and how you find yourself here as the CEO of the Wealth Elevator.
Yeah, thanks for having me. I guess like the way I'll start it off, I used to be an engineer in a previous life. Up until that, my parents always taught us to go to school, study hard, get a master's degree and doctorate degree and work at that job for 40, 50 years. But bought a house to live in very quickly out of college. And I just started to rent it out because I was, like a lot of young working professionals, you're working on the road a lot. So I was like, well, I'm just going to rent this out. I was in my early 20s, and that was kind of the start of building up a rental real estate portfolio. That was in 2009. Fast forward a few years to 2015, I had 11 rental properties, and I had kind of reached this pedestal that I talk about in my book, The Wealth Elevator. Going from the first floor, buying rental properties, to getting more involved in larger deals, syndications, and private placements. And this is where I think where some of our paths align here, where you're starting to realize the difference between somebody with just a handful of rental properties. I had 11 at the time, and higher net worth investors, and then getting near the threshold of family office, and then more institutional operators. But that's a little bit about my background.
Wonderful. Quite a pivotal journey, it seems, and totally relate to everything you're saying about being guided from that generation of our families and our parents, get the degree, do all the tried and tested methods that give you a very long-term, hopeful trajectory of becoming wealthy. And I'm excited to hear more, of course, about the pivots that you've taken additional to what you've already done. So, one of the things that I'm curious about is, as a family office consultant, you're obviously exposed to a myriad of strategies, mindsets, and were there any of those that stuck out as consistent ultra wealthy compared to the average investor? What are those things that differentiate those two buckets of people?
Yeah, I mean, I think traditionally your family office, 50, $100 million net worth family and above. I mean, first off, it's very rare that it's the first generation that has created the wealth. It usually takes a few generations to get up to that point. But even if it does, it always needs to be created with business powering it. Nobody got to 10, 20 million plus in one generation with just passively investing.
Right.
That said, money creates opportunities, and I think one of the things we talk about is maybe setting aside a few stacks of 50 grand for our kids to start businesses so they can kind of get on that track. But I mean, that's something I've kind of realized. I mean, I'm first generation multimillionaire. My parents did not have millions. So obviously I came to this world more, building my own business from an operator perspective. I'm just fortunate enough to be in a world of a real estate operator. And as we know, many high net worth families, the first two patriarch foundational generations are the ones who created the operation in terms of their business. And there's usually a movement to more conservatism. Most likely, it's hard. It's like gravity. The generation 2, 3, 4 aren't going to have the same work ethic. And likely they're just, businesses, you need luck. You need luck, and it requires a lot of hard work. But I point to luck. And people who are, confident yet practical understand that to ask your third, fourth generation to recreate the magic that you did is not practical. So what you'll see a tactic used a lot, and this is kind of where I kind of very close to, is you'll see the family, buy up, if they run a dentist office, they'll buy the real estate, buy the medical office or any other brick and mortar business, they'll buy the real estate. Why? Because they start to eliminate some of the biggest line items on their P&L. And they almost make it to a point where an idiot can run their business. That idiot may be their son or daughter or their brother, son-in-law or daughter-in-law that they dearly love. But, that's why that's that movement to transitioning from a business operation to a bit of a holdco with the real estate underneath their business.
Makes total sense. And that, I think, does lead into some of the innovative wealth management approaches that family offices would utilize, right, to grow and preserve the assets over the long term. Perhaps that's more of the starting point of how they actually get the wealth at first. Can you talk about any other innovative wealth management approaches that they're using that perhaps the average man and woman out there is not?
Yeah, I mean, in addition to, working down their P&Ls on their business and eliminate debt, eliminating certain line items by paying off their real estate. I think at that point you start to realize like what are the synergistic different businesses that can help this. I can only speak to what I'm in, right? Real estate operation. We buy, Class B and C apartments. We also develop too. So there are certain synergies in terms of the operation that help all those business units. So for example, if you have a HVAC company, if you own your own property management company, pool cleaning, right? Maybe not a full-blown business, but 2 or 3 guys on your payroll that can take down those services, but also service other businesses. And we'll use a lot of these different vendors as potential lead flow for us. Again, our main business is acquisition of real estate. So if there's any insider information we can get from our vendors to know when somebody's going through tough times or it's just merely wanting to trade out of their asset, is critical for us. But again, getting outside of our world of real estate to, kind of give a different idea. Maybe you run a plumbing company and you hire a lot of, blue collar staff that you might want to also grow a restoration company on the side. Those are synergistic companies with the HR, human resource components very similar. So why not use that synergies? Just to name a few, right? And so I think everybody who has $100 million or more, you probably got there because you or your previous generations created a business. So you got a business. What can you acquire putting on your mergers and acquisitions hat, I think is the lens that you need to look forward.
Now, everybody's got blind spots, and I want to touch on obviously some of the blind spots you've identified over your time that middle class compared to ultra wealthy again may have and not be aware of. But before we go there, why don't you tell us about any of the blind spots you've come into awareness over the years for yourself?
Yeah, I mean, when we first got started, renovating, going from single family homes to larger multifamily. I mean, we started with smaller 50 unit, 100 unit Class C properties. So Class C are a little bit rougher properties built 1960s, 1980s. So your clientele is a little difficult. But that was all we could afford back then. And that's really where you make a lot of money. If you have that fortitude to do it, we would consistently have just 80% of the people pay on time or even pay. If that gives you any sense of, kind of the headaches involved in it. We later moved up to larger assets, cleaner assets, and then obviously just developing brand new stuff where we can build it for a much lower price, cheaper than replacement costs. But, I think that was where you start to, just kind of calling ourselves out, like we fell in love into a business. And luckily with real estate, with the population growing, and especially in the lower middle class, which is our kind of workforce housing demographics, it's in an inclining business or inclining asset class. The market fundamentals are good in the long term, but there's different places to be a part of that. And maybe since I live here in Hawaii, there's a swell coming on the North Shore. There's different beaches you could ride that same swell is an example, right? Like real estate, lower middle class demographics, the lower middle class population is growing due to immigration, and just, the rich are getting richer and the middle class is going to the lower middle class. There needs to be more housing in that sector. And that's where we want to be. We want to ride that wave. No different than, we're starting to, look at investing with assisted living developments. The baby boomers, that's obviously a uptrend that we want to be a part of. And to use another analogy, we figure out what haystack we want to be in, and we dive in and pick the right haystack, meaning the right operator and the right deal.
Awesome. You've got and I think I'll say this correctly, the Hui Deal Pipeline Club. Tell us more about that.
Yeah, I mean, it was essentially started out as a means to crowdsource, deals within our little community that we had. Obviously, since then, it's grown immensely. We've got well over maybe 1,000 investors that have invested, serious 5-figure checks and above. So it's allowed us to write larger checks as a whole, right? So, in the past, we've gone in as a group and gone in with $5 million, $10 million. And at that point, we can command, better GP LP splits for us. And also, people are sophisticated to understand more of the capital stack placement, right? We can get, certain things like preferred equity, higher, payback, quicker payback more than the common equity. There's things that we can negotiate to sweeten the pot for us because we are writing a bigger check than a normal guy at $100,000 or even a large family office writing a $500,000 check. Especially because, every deal is separate, but, we are a relationship company and we value relationships with our partners and vendors and operators. They know that, it's a long-term relationship. We come in, write a $5 million check for one deal, but we're watching and, seeing how the relationship goes. And we'd like to do repeat business with people. But that has allowed us to kind of grow the community, with investors. And and a part of it too is, the values. I grew up here in Hawaii where we live on an island. So which is a bad thing is everybody knows you. The good thing is everybody knows you. So you can't make an ass of yourself. Right. But the good part is, it's a family atmosphere, right? People throw in large amounts of money. This is serious. But if you can combine it with, doing it with people you trust and and you have a community atmosphere, I think that's what we all want at the end of the day. I don't care how much money you have. Social relationships are the currency of the wealthy. And to align investing in business with those people is fun. It can be a little risky, but hey, you don't invest in anything you can't lose.
Yeah, for sure. How do you make sure that they're comfortable to leverage your expertise with a hands-off approach? And do you find that's been an obstacle at all?
Well, we always just try our best, right? When you talk about due diligence, we have a free analyzer checklist with, I don't even know how many 100 questions and spreadsheets that you can check. There is no level of due diligence that you can, it just is endless, right? So I'd be remiss to say that, yeah, we're good, we're 100%. No, it's never the case. I think we do a good job in blending, building that relationship and, getting that leverage in there for future business, from a relationship standpoint. Obviously, we do the background checks, we vet old projects that they're in. This last project we entered into, obviously we check that asset and we check the comps, right? But we also go check out the other assets and see how they're progressing there, right? Because it's, when you're on that scale on an operator doing a $1 billion, $2 billion of assets under ownership, they're not doing it themselves. It's the team, right? So you can kind of see consistencies in the property management team all the way to the front desk. And obviously we run the numbers just like anybody else can out there. But I think um, our biggest thing is that we are operators ourselves, right? We've done, I think, well over 60, 70 projects ourselves, and we kind of know what to look for, and we know where you can get stuck. We've had our lessons learned throughout the years. And I think at the end of the day, we're just trying to select the best projects with the best people with what's available. And that's why I tell investors all the time, especially the new ones who are like, well, I want a good one. It's like, well, in my opinion, this is the best right now. And as an investor, you have to somewhat dollar cost average. You can't just go into one, two, three deals in a quarter and be good. Right? You've got to consistently increase your portfolio and dollar cost average over time. And we've seen this in 2021 to 2022. That was the peak of the market. Right now, things are 20 to 30% cheaper. If you only invested in 2021, 2022, you got hit with the hammer and you've got a sour taste in your mouth. Um, Contrary to that, personally speaking, I mean, I've been investing a lot longer than that, had deals in the hopper. And then when the music stopped, I'm in the long term, I'll be fine. And that's what investing is all about.
Sure. And so you mentioned a few things there. It's curating and saying this is what we're dealing with right now, and trying to get them comfortable with those facts, and enlarging your portfolio given all the conditions that are around, macro, micro, whatever the case may be. What key factors are most significant for you when you are evaluating various real estate investment opportunities, right, to offer
Yeah.
for your network?
Yeah. I mean, obviously, I think people first, but taking all that stuff aside, right? Like, I think to get to where your question is going is like, what are the numbers you're looking at? I would say the majority of it, half of it, maybe even 80% of it is like reversion cap rate. What are they assuming for occupancy? And what are they assuming for the rent escalators, inflation assumptions? I mean, if you want, we can go down those, but those are usually the top three things to just spot check, because that's usually indicative of how conservative they are on their performance. And then, obviously you check the rent, the rent comps too, right? There needs to be some vetting and then infield analysis. Our team just got back from this last one where they went and, walked those units. And then we wanted to see what the new units were leasing up with, not doing any renovations just to make ready. So, that's nothing beats that, right? That somebody actually paid rent to verify those performer rents. And at the end of the day, I think people would agree, and kind of talking what we were talking about earlier, this is not rocket science, right? This is not venture capital where we don't know if this is going to fly. We These are boxes, these are apartments. You pay a certain square foot per foot. Sure, location, right? But for the most part, these things they sell for a pretty consistent band in terms of rental properties.
100%. Speaking of location, you mentioned Hawaii is the primary base. Are there any other locations within the US that you
Oh no,
focus
I
on?
would never invest in Hawaii. Heavens, no. Yeah, I
Got it.
live here. Yeah,
Got it.
yeah.
I
Live
was
where
just
you
gonna
want. Invest
say,
where the numbers make sense. Um, I mean, obviously we try to invest in red states because we're the landlords, and landlord friendly laws, the red states typically are better. We also believe that the growth states are more of the red states, especially for us who are like, we go after the lower middle class, the workforce housing. That may be different if we're trying to cherry pick, nicer luxury apartments and those type of developments. Who knows? Maybe the blue. We've never really looked into it, but we kind of stick to what our business model is. Again, that whole haystack, right? Analogy. We stick to that haystack. Um, but that's kind of where, so like we like the Arizona, Texas, Alabama, Florida, like the Sun Belt narrative. Not to say that we won't venture out. Like we've done things in New York, we've done things. I've done things in Atlanta, Indianapolis, places like that. But I think part of this too is, especially when we're operating the deal, like we need to cluster our property management teams in one place. we like to get 1,000 units in one area. That way, if somebody is literally like, your lowest level of staff, your property manager or your maintenance guy is sick, we can help fill in, right? Or like what ends up happening a lot. I mean, property manager, you have a lot of turnover. I mean, it's a tough job. Not compensated too well, in my opinion. But you need that right personality in there. But a lot of times like you have like a more junior person that you just have to kind of bring off the streets. Maybe they have a college education, but they're pretty green, and you have to mentor them with some other more senior person. So if that senior person is 4 miles, 10 miles down the street, then that's easy for that mentoring to happen and kind of the review over the shoulder on that level. So like, as much as we'd like to invest in the 12 best MSAs out there, we've kind of learned that we need to kind of have, operate our deals to the best of our ability and kind of stick to the certain markets. But when we want to get diversification for our investors, we need to go and use this different other mode where we are actually a fund manager in representing our folks into another project or set of projects in a different geographic area.
Yeah. So it seems you've been able to generate over $45 million in distributions for your investors. How have you done that? And talk to us about any ways that you've mitigated risk or how you maximize the returns for the investors.
I mean, the business plans are pretty simple. And there's a few of them. The first one, like I said, when we got started, renovate units, cosmetic rehabs, maybe $5,000, $10,000 a rehab per unit. So it doesn't seem like that much money, but when you rinse, wash, repeat, buy the materials at scale, new flooring, new appliances, new paint job, some playground equipment, jazz up the leasing office, re-slurry seal the parking lots. You can usually bump these rents up $100, few $100, kind of on the high end. And at that point, commercial properties are evaluated off the net operating income divided by the cap rate. Or for some of the business owners out there, it's the EBITDA, right? Income minus expenses. And when you do that, you increase the value of the property and you sell it. So, the nice thing about real estate is you get pretty nice leverage there. So you don't really need to do it too much to these NOIs, usually about 10 to 20% lift on the NOI in 3 to 5 years. And that's enough for us to double our money there, our equity. The other vertical that we started in 2020, we saw a lot of people getting involved in this business. So we wanted to try and differentiate ourselves, still utilize our expertise in terms of the PM teams, but also a big part of that that's hidden that not a lot of people talk about is our ability to get deals. Especially, and then when you're talking development, the land, right? A lot of that we've bought from people in the past are wealthy people. And it kind of brings things a little full cycle, right? Like we're talking about family office people. A lot of these guys they'll be developers themselves. And that's kind of where I'm like, well, I'm going to take the hint. There's a reason why these guys are doing it. Or they've just owned a rental property or a 300-unit apartment complex by themselves. And they're selling the asset because the kids they'd rather take the money and run and blow it on Ferraris and whatnot. Right. So it makes a great situation for us to buy it. And that's kind of where, and it kind of helps me on like the consulting side to get that insight into these families. I mean, this is kind of sad, but it happens all the time where you have the patriarch who is the sophisticated investor. They're literally on their deathbed and the widow has to sign documents to send it over. And then the kids, they went to college. They're not dumb people. Not all of them are crackheads and, nincompoops, right? They don't need to grow their money. But that's kind of where we'll pick up these types of properties or their land to develop on to kind of do our second, main way we generate money. And in those projects, obviously you're bumping the net operating income from nothing to, huge amounts there. And, that's how you generate returns.
Was there any time where your own personal investment strategy was challenged by, that of your investors where there's non-alignment or how do you merge those two? And is there a need to do it? Perhaps it's all the same. Just maybe highlight that.
Yeah, I mean, like the that first business plan I mentioned, the cosmetic rehabs where you're bumping the rents up 100, few $100 per unit. It sounds great, right? And you're cash flowing through that time. The problem there is, I think there is a lot of competition doing that same thing, which is why we started our development arm too. But like I said, all you're trying to do is bump the net operating income by 10 to 20%, assuming a flat economy. Now, what happens when you have interest rates skyrocket, 40-year high interest rates, quickest time in history? Oh, prices go down 20 to 30%. So even if you implemented your entire business plan, you're still right where you bought it from or less, right? So I think that's kind of exposed that business plan. Not saying you don't do it, right? I mean, you dollar cost average, and when a black swan event happens, like how it is, if you look at like the last 12 years, it was smooth sailing and you could make a lot of money, but there is that exposure, maybe 5-10% of the time, if I'm being kind of conservative, where you would get a 2021, 2022 from a period of 2029 to 2023, right? So I think investors listening are pretty sophisticated to think, well, yeah, that sucks, but that was, I'll take that 1 out of 10 whammy rate, which is why, I say just diversify and, perhaps get into projects where there's bigger whacks of NOI. Yeah, this is why people do development, because they create so much tremendous value there. And you're a lot more insulated in case of market correction.
For sure. So talk to us about helping people, the average, middle class human, to get out of this rat race that, a lot of us seem to just inherently find ourselves in. What steps do you take to help people like that? Is it with the Wealth Elevator? And perhaps talk to us about books and anything else you'd like our audience.
Yeah, I mean, obviously, our business and my business is the operation of investments. But man, this thing has changed my life tremendously. I mean, in 2007, I started to work for a Fortune 50 company as an engineer. I did not enjoy one bit of it. I learned a lot though, working for a Fortune 50 company, which I think is a big, big thing. I'd like my kids to do, go to college and work for the man for a while, get promoted at least 2 times before coming and work for the family business and getting that a great responsibility. I think that there is a lot of hardworking people. I mean, a lot of these guys are friends that I don't see these days, obviously, but like hardworking people, your doctors, your dentists, your middle level, upper level management. A lot of folks that, I mean, like my parents' bio, right? They totally go to school, study hard, but you just invest in this 401k stuff and all these traditional investments, and you're just getting screwed. I mean, Wall Street's taking 1/3 to 2/3 of the profits, and you're just taking all the risks. And then the biggest part of this is like, it's the middle class that pays all the taxes. It's not the wealthy, that use passive activity losses, real estate professional status to drive their income down. And it's not the poor people out there. That's for sure. It's the hardworking middle class that builds bridges out there, does the surgeries for people in need. That I always thought that was wrong in the world. But the problem there was there's never any books written for people who are $1 million net worth and greater. I mean, there's Rich Dad Poor Dad, but that's really targeted towards like the lower class, right? People who are getting started, and it's very esoteric. It says very little in many words, and there's no action plan there. And then, of course, there's all the Dave Ramsey, I'm there. I actually met him earlier this year at a conference. I like him. He's a cool guy, and he's got a great message. But he speaks to a lot of people in debt, right? So in my book, I'm an engineer, so I have all these tables of, the different levels of the wealth elevator. The basement level, I think, is what Dave Ramsey, Susie Orman typically cater towards. The first floor was where I was at in my 20s, buying little rental properties. The second floor, I was starting to get involved in private equity, syndications, and private placements. And then, there's a couple more floors after that. But, what I realized, there's a certain amount of strategies based on where you are at in this journey. There's paradigms to this wealth building journey. So to just put one size fits all strategy for everybody is not, I don't think that's smart. So the whole idea of the book was to break everything down in terms of what level you're at, what's your cattle grade, and then now let's talk. What's your action plan in terms of investing? What's your mix between alternative traditional investments? How to use the passive losses to drive down your income? Accredited investor banking, privatized banking. A lot of high net worth families will utilize life insurance, but in a unique way. And then, a little bit of mindset too, right? I mean, I always say $4 to $5 million net worth for most of my clients is, you know, not the goal of it. Obviously, you should take it well past that. And I think most people get to 8 figures plus by the time they pass away to their family. But really, once you've hit that end game level, you have enough. Most of my clients are not egregious folks. They give them $10,000 to $20,000 a month, and that's a good life for them. And I'd say at that point, the emphasis falls more on teaching the next generation these values and money lessons, but also, continue to grow the net worth. If 90% of people's wealth leaves their family in 2 to 3 generations, it's not the second generation. They typically go to good schools and around wealthy people, and peer pressure keeps them in the game. I is my guess, but it's that third generation who your kids bought everything for, and they're just, no fault to them. What we try to do is, I'm big on community. This is how we monetize our group. We have a paid mastermind group where we're big on, obviously social relationships, deal flow, relationships there. But I always say, well, bring your kids in, you know, no better to bring your 20-year-old into this group with some young group. Maybe they can meet a 30 or 40-year-old. I sure heck not going to listen to my 60, 70-year-old father, you know. Actually, thank goodness I didn't, because he did all the 401k stuff. Never bought rent. They said don't buy rental properties because people will mess up your property.
Right. Yep. 100%. I've heard that one before too. And so it sounds like you're bridging the gap for those generations by providing longevity through education, the generations to come, getting them into your community, your funnel, your pipeline early in the game so that they know the strategies to take to sustain that wealth. Is that correct?
Yeah.
Am I correct in saying
yeah,
that?
it's got to be in, that's not the real business. That's not the real way to make money, right? So it's got to be done in a scalable way. And what I've realized, even if you take people with $1 million, $2 million net worth, by that time they're typically in their 40s, 50s. To some extent, you can't teach an old dog new tricks, and they've got liabilities, they've got families. They just can't try new things. They can't take the risks. A lot of these people are not business owners. The whole getting out of your comfort zone isn't quite there. Now, that's what we hope to do change by, holding them by the hand, getting them around the community of like-minded people. I think that being in that crucible is very important. It was important for me, but that was kind of where, just kind of creating that culture, and that, people, try it out. What I realize, that I talk to a lot of people that read the book nowadays, not all of them will follow through, right? It's not for everybody. But hey, financial freedom and generational wealth is not for everybody. Shouldn't be. And who would get our coffee? Who would build our bridges, right? Who would benefit society, right? I think that said, I think most people with wealth who earned it themselves, they usually understand that they need to produce some utility in the world, have some sense of purpose and betterment of, leaving the world a little bit better than they found it. So they continue because they have that value. But, I think most people don't have that. And that's why they need to go to school, get a job, work at that job, pay off your mortgage.
Awesome. Where can our viewers, listeners check out your book and perhaps get copies for themselves?
They can go to Amazon. They can just search The Wealth Elevator. And if, people buy a copy there, shoot us an email, team@thewealthelevator.com. We'll connect you with the audio book or vice versa, whatever you buy. I know a lot of the cool kids are doing the thing where they buy the physical book and they get their finger and they listen to it on audio at 3x speed. They just devour books that way. But yeah, if people are accredited investors out there and they want to reach out on to us and see what we're doing as far as deal flow, they can reach out lane@thewealthelevator.com.
Awesome. Lane, thank you so much. Really informative conversation, really insightful. And I'm looking forward to seeing and learning more from you and the Wealth Elevator. I'm Carmel Fisher, and you're listening and watching The Harvest. Stay tuned.
That's it for The Harvest, available anywhere you listen to podcasts.